Hello friends, this is ProVG. Welcome to my channel. You can see that nowadays the headlines are filled with news of escalating tensions and conflict in the Middle East. While the human toll is primary, these events ripple across the globe, impacting economies in unexpected ways. India, despite its growing strength, is not immune. Let's explore how these developments could significantly impact India's economy. The oil factor, the engine that could sputter. When we talk about the Middle East, the first thing that comes to our mind is oil. For India, this is a major concern as the country imports over 80% of its oil needs, with a significant portion coming from the Middle East. Most Indians are unaware of how exposed their economy is to fluctuations in this region. India imports nearly 85% of its crude oil, amounting to roughly 5.7 million barrels daily. A large part of this comes from countries like Saudi Arabia, Iraq, the UAE, and Iran. The Strait of Hormuz, a narrow waterway between Iran and Oman, is crucial as it handles about one-fifth of the world's entire oil trade. Since the conflict escalated, disruptions in shipping through the strait have led to increased insurance rates and rerouting of ships. Consequently, Brent crude oil surged to over $117 a barrel at the peak of the crisis, up over 40% in just weeks. For a country like India, which spent $137 billion on crude imports during 2025, even a modest increase in oil prices can send shock waves through the entire economy. The oil shock, your petrol, your kitchen, your EMI. Higher oil prices have direct repercussions for everyday consumers. Fuel prices. When the government cannot absorb increased costs, petrol and diesel prices rise. This affects everyone, from auto rickshaw drivers to the cost of transporting goods and airline tickets. 2. Inflation. A 10% rise in crude oil can increase India's consumer price index by zero point 0.5 percentage points. This is significant in an economy already on high alert for inflation. Economists warn that prolonged effect could push inflation to nearly 4.8%. Third, government subsidies. India budgeted approximately 2 lakh crores, around $24 billion, for energy subsidies in financial year 25-26, mainly for LPG cooking gas and fertilizers. If oil prices remain above $80 a barrel, the subsidy bill could increase by an additional $4 to $6 billion, necessitating higher taxes, more borrowing, or cuts in other spending areas. Beyond oil, the ripple effects on trade and beyond. The conflict's impact goes beyond oil, affecting other significant areas of Indian economy. Our key trading partners like countries UAE, Saudi Arabia are among the India's top trading partners. Prolonged conflict could impact bilateral trade volumes, affecting sectors such as gems and jewelry, textiles, and food exports, infrastructure projects, and investments. India has a substantial infrastructure projects and investments in the Middle East. The geopolitical instability can lead to delays, project halts, or even abandonment affecting Indian companies involved. The remittance risk, it is to the order of 4.3 lakh crores, is under threat. India holds the title of the world's top recipient of remittances. In the fiscal year 2025, Indians living abroad sent back an astonishing $135.4 billion, equating to over 11.6 lakh crores, a 14% increase from the previous year. A significant portion of these remittances, about 38% or $51.4 billion, comes from Gulf countries such as UAE, Saudi Arabia, Qatar, Kuwait, Oman, and Bahrain. With approximately 9 million Indians working in these Gulf nations, many are employed in sectors like construction, oil services, hospitality, and retail. These sectors are particularly vulnerable to any economic downturn caused by regional conflicts. If construction projects come to a halt or if the Gulf economies contract due to war, Indian workers could face job losses, salary reductions, or forced repatriation. For countless families in Indian states like Kerala, Uttar Pradesh, Bihar, and Tamil Nadu, who rely on this Gulf income for necessities like school fees, home loans, and daily expenses, the impact is far from theoretical. It affects their everyday lives. The rupee and the markets. Increasing oil prices lead to a higher import bill and a widening trade deficit, which usually results in a weaker Indian rupee. The rupee has already depreciated to around 91 rupees to 92 rupees per dollar, with the predictions of further decline. As oil importing countries demand more dollars to pay for fuel, the rupee's value diminishes. Continue. As oil importing countries demand more dollars to pay for fuel, the rupee value diminishes. This depreciation triggers a feedback loop. Imports become costlier, inflation rises, and the RBI is compelled to maintain higher interest rates for a prolonged period, making loans for homes, cars, and business more expensive. The stock market is also under pressure. In just first week of the recent escalation, foreign portfolio investors withdrew approximately $2.4 billion from Indian equities. When global investors become anxious, they often move their investments to safe havens like US Treasury bonds, leaving emerging markets like India to deal with the consequences. The RBA has been intervening, reportedly selling around $12 billion from forex reserves to stabilize the rupee. India's reserves, which stand at comfortable $670 billion, offer a buffer. However, continuous conflict necessitates sustained intervention, which can deplete this buffer over time. Trade routes, airlines, and supply chains. The disruption is not limited to oil. India's physical trade is also affected. India exports engineering goods, food products, building materials, and manufactured goods to Gulf Cooperation Council nations. Analysts predict that approximately $15 billion of India's merchandise exports to GCC markets could be at risk if disruption persists. Why? Freight costs and war risk insurance premiums are rising. and shipping companies are either rerouting, adding significant distances and time to journeys, or refusing to enter the region altogether. Freight costs have surged by about 45% since October 2024, squeezing exporters who already operate on thin margins. In aviation, airspace closures over Gulf countries force Indian Airlines to reroute long-haul flights to Europe and beyond, increasing flying time and fuel costs. This results in higher ticket prices for travelers. India's vulnerabilities and its strengths. India faces vulnerabilities but is not without defenses. Here is the reality. What are all the vulnerabilities? India imports 85% of its crude oil, creating a major vulnerability. The rupee is under pressure at 92.93 a dollar. India's fiscal deficit could widen considerably with rising subsidy burdens. 9 million workers in the Gulf are exposed to an economic slowdown there. The strengths of India: foreign exchange reserves of over $670 billion provide the RBI with the means to defend the rupee. India has diversified its oil sources, heavily importing Russian oil in 24-25, although geopolitical pressure from the US complicates this route. Tensions are easing slowly. India's service exports, software, IT, BPO remain largely unaffected by Middle Eastern conflicts and continue to generate steady dollars. India's GDP growth trajectory of 6 to 7% offers the government some fiscal leeway. Geopolitical tensions often prompt countries to reconsider their defense strategies, potentially leading to increased opportunities for domestic defense manufacturing in India, in line with Atmanirbhar Bharat initiative. Strategic positioning could strengthen India's diplomatic and economic ties with other major powers, opening new avenues for trade and cooperation. If the conflict is short term, India can weather it. However, a prolonged war that closes the Strait of Hormuz for months, disrupts GCC economies, and drives oil prices to $150 could cause a structural shock, reducing GDP growth by 1 to 2 percentage points and pushing inflation to uncomfortable levels. You feel what you should do in these circumstances. If you are an investor, high oil prices generally benefit energy stocks like ONGC and Oil India, but hurt aviation, paint, tire, and FMCG companies with high input costs. So, try to monitor the rupee. If it weakens significantly, IT exporters like TCS and Infosys may benefit as they earn in dollars. Gold often rises during geopolitical uncertainty, which could serve as a good hedge for you. For families with members in the Gulf, stay informed about their employment sector as construction and hospitality are most exposed. If they are sending money home, they should do so through formal channels while systems are still functioning smoothly. As a citizen, recognize that India's energy diversification and transition to renewables is not just an environmental goal, it's a strategic economic necessity. Each solar panel installed in India means one less barrel of oil to import. Despite the challenges, India's economic fundamentals are relatively strong compared to many nations. A diversified economy, large domestic market, and proactive policy measures provide a degree of resilience. Call to action. The Middle East conflict is not just a news headline, it's a live economic stress test for India, challenging Indian energy security, currency, fiscal management, and the livelihoods of millions of Indians abroad. The stakes are high: $137 billion in oil imports, $51 billion in Gulf remittances, and $15 billion in trade exposure. This is India's real stake in a conflict it did not initiate and cannot control. What is the best course of action? Stay informed, understand your vulnerabilities. Encourage leaders to accelerate India's energy independence because the ultimate long term solution is to reduce reliance on Middle Eastern oil. If you found this analysis helpful, please like, share, and subscribe and encourage me. Share your thoughts. What aspect of this issue impacts you the most? Petrol prices? Family in the Gulf? The markets? Please comment below